Okay, so the next stock on this list is Meta. Now, Meta, or Facebook, reported earnings on Wednesday, February 2nd, and the stock dropped by 26% after the announcement, leading to a huge $20 billion loss in value for the company, which is actually a new record for the largest one-day drop in value in the stock market's history. Now, there's probably been the most insane number of headlines that I've seen come out after this earnings report, with every stock genius in full 2020 hindsight mode saying that Meta's been doomed, and this was obviously going to happen. However, on this channel, I try to desensationalize a lot of these things and give you guys accurate information in full context so that you can get a complete picture of what's actually going on with the company and not just a bunch of lazy reported stats that may explain current parts but won't really give you the full picture. So let's look into the report and figure out if headlines like this, Facebook stock crashes after user base starts shrinking, it's one of the worst crashes on the stock market history, is true. Okay, so here's what Facebook actually reported. Earnings per share came in at $3.67 per share versus $3.87 expected, which is an earnings miss. Revenue came in slightly higher though, at $33.67 billion versus $33.4 billion expected. Daily active user growth came in at 1.93 billion versus 1.95 billion expected. Now, just to put that in context, the whole world has a population of 7.9 billion people. So 1.93 billion people using a Meta app daily is a massive number. Those daily Facebook, Instagram, and WhatsApp users are about 1 out of every 4 people on the entire globe, which does include people who live in parts of the world with no internet access. Facebook's revenue and guidance for the first quarter of 2022 came in at 27 billion to 29 billion, which is short of the 30.15 billion expected, which would be somewhere between 3 to 11% growth from last year. Now, what's happened is Apple made some changes to their privacy settings that have hurt Facebook's ad business uniquely compared to Google. During the earnings call, Mark Zuckerberg said that Apple's ad tracking transparency feature, or the ATT, is going to cut out about $10 billion in profits in 2022. So let me explain how that's going to happen. Your Apple devices have identification for advertisers called an IDFA, and this is basically what Apple uses as an ID for advertisers to understand what you're interested in without identifying you personally. So for example, I recently turned on all of my ad tracking to test out signing up for focus group interviews. After I turned on my ad tracking, I just started Googling focus groups until basically all of my Facebook and Instagram ads show up as paid surveys, medical research, or focus groups. Well, the advertisers don't know it's Nick Daly searching for focus groups 15 times in 45 seconds. They just know that this particular ID is very interested in focus groups. Now, the problem is that because so many people have opted out, Facebook isn't able to target its users as well. So if I had kept all of my ad targeting on, in theory I could have done the same search, but it wouldn't have given me all the focus group ads that I'm now getting because advertisers wouldn't have the information to know I'm very interested in focus groups. Now, Apple has introduced a replacement for their old ad tracking system that's still more privacy friendly. Still, Meta and Snap have said that it's less efficient than the previous version. So the bigger issue for Meta is they don't own the platform that customers are using Meta on. If they can only access customers through Apple devices or Google devices, they're sort of at the mercy of Google and Apple. And Google's business is way different since it's ads that are served when somebody's actively searching for something, basically telling advertisers what they want to see, versus Facebook, which actually has to figure out what types of ads consumers are likely to interact with. Now, some analysts are claiming that customers aren't able to get the same return on investment for Facebook ads, so they've ended up buying more Google ads. Now, there's no concrete information stating this, but the idea does make sense, and this is something that we have to pay attention to. Okay, so the red part of the bar is the last quarter of Facebook's earnings, with the 3 quarters before giving you the full year of earnings for each quarter. Now, this definitely shows flat growth as Facebook tries to figure out how to navigate ad tracking better, so not a great sign. Still, in all seriousness, the situation could have been much worse. However, when we look at the full year revenue and net income for the past 10 years, it's pretty hard to tell that anything happened bad on this chart, and from here it actually looks like Facebook is continuing along as normal. Now, when we look at the revenue growth versus expenses, we can see that Facebook actually has almost no cost of revenue, which does give Facebook some room to work with. If advertisers using Facebook ads are going to experience less efficiency in their ads, those bids for the ad slots will come down over time, which will decrease some of Facebook's gross margins. Now, Meta's segments aren't too surprising. They're actually pretty dominated by the family of apps segment, which makes up all of their profit and revenue. But I want to point out that the Reality Labs segment has a long way to go and it's entirely supported by the ad business. Last year, they actually lost over $10 billion on their Reality Labs. Now, I've already talked about what I think about the metaverse, but basically, to make a long story short, I'm just not that impressed by it. I don't really think it's going to catch on, and for right now, I just don't really take it into account when I'm looking at Facebook's valuation. To me, it's still all about the ad business. Now, Facebook actually has a pretty interesting chart showing the daily active people, which is defined as the number of people who visited at least one of their apps on any given day. We can see that since December of 2019, Facebook has increased this number from 2.26 billion to 2.82 billion by the end of this year. Okay, so when we look at the current earnings forecast for Meta, the current expectations are for them to grow from about 101 billion in revenue and 39 billion in profits to 176 billion in revenue and 46 billion in profits by 2024. When we look at the revenue growth, it is much slower than what Meta has been doing in the past. However, net income growth is actually projected by 2024 to be a little slower than the revenue growth, hitting only about 9% by 2024. So I think to value Meta, we should use a growth rate of 8%, which is a super conservative number for the bottom end of the range, and 12% for the top end of the range. This gives Meta a fair PE range between 18 for the bottom end and 26 for the top end. So when we look at this valuation charted out, I want to say that I am going extremely conservative in my opinion with that 8% growth rate, but Meta's current price of $237 per share is very cheap compared to what the company should be worth. By 2024, Facebook has an upside of $299 using a very conservative measure and a high-end range of around $432 per share using a more moderate but still pretty conservative estimate. However, if earnings dip like the current forecast says during 2022, I do expect that Facebook's share price will stay lower. But also keep in mind that this is the low-end estimate, and if Facebook recovers better than expected, they definitely will exceed these returns. Now, I think that Facebook will figure out a way to adapt to the new privacy changes, and I think most of us recognize how good Facebook has been in the past when it comes to ad targeting, but at least for the next year or two, this is an obstacle that they're going to have to figure out how to overcome. So right now, I would say that Facebook is between a buy and a hold. It's definitely cheap, and I expect that the stock is going to rebound, but I think it may stay down if 2022 does report a decline in earnings in comparison to 2021. But if you don't care about this dip and you're entirely focused on 2024, this stock is of course a buy. Now that video that you just watched is part of a much larger video where I covered earnings for multiple stocks. So if you want to see that video, click this right here. And as always, thanks for watching.